Rate cuts are supposed to help markets. Money gets cheaper. Bond prices usually rise. Businesses can refinance. Consumers can borrow more easily. Investors hear those words and imagine a giant green button labeled buy. But some of history's most aggressive rate cuts arrived while stocks were falling, businesses were weakening, and recessions were already underway. That sounds contradictory. It is not. A rate cut can be medicine. Medicine is useful. It is also evidence that somebody may be sick. The important question is not whether rates are falling. The important question is why they are falling. By the end of this video, you will know how to separate a preventive cut from an emergency cut. You will also know which signals reveal whether cheaper money can overpower weaker profits. The Federal Open Market Committee sets a target range for the federal funds rate. The committee has 8 regularly scheduled meetings each year. That rate influences other short-term interest rates. Those rates influence borrowing, spending, employment, and inflation. Think about the economy as a machine connected through financing. A lower policy rate can reduce interest costs. Mortgages may become cheaper. Corporate loans can eventually refinance lower. New projects become easier to justify. Future company profits also become more valuable when investors discount them using lower rates. That is the bullish chain. But policy works with delays. A company facing collapsing orders today does not instantly regain those customers because the central bank changes one number. A household worried about layoffs may not borrow more simply because financing became slightly cheaper. Markets react immediately. Economic relief arrives gradually. That timing gap creates the trap. Central banks rarely cut rates for entertainment. They cut because inflation risks have eased, growth risks have increased, financial conditions have tightened, or some combination appears. Sometimes that is healthy recalibration. In late 2024, the Federal Reserve described its cuts as a recalibration. Inflation had moderated. The labor market had eased. Officials believed less restraint was appropriate. The economy did not need an emergency rescue. Other times, the cut arrives because the damage is spreading faster. Federal Reserve researchers examined rate behavior around the 1990, 2001, and 2008 recessions. Across those episodes, the federal funds rate fell about 4.4 percentage points from the business cycle peak through the following 24 months. Rates did not cause every decline occurring around them. The direction reveals the policy response. As recessions developed, rates followed economic weakness downward. The same research notes that interest rates often began declining as the business cycle peak approached. That means the first cut can happen near a turning point. It can look like relief before official data confirms what already changed. Recessions are clear in hindsight. They are not announced instantly. The National Bureau of Economic Research dates American business cycles. It waits for enough evidence and revised data. The recession beginning in December 2007 was officially announced in December 2008. That was 12 months after the peak. Imagine trading only after that announcement. You would be reacting to an economy that had already changed for a year. This matters because markets, policy, and official confirmation run on different clocks. Markets price expectations. The Federal Reserve responds to incoming risks. Official recession dating confirms the historical record later. So, a rate cut is not a clean forecast. It is one piece of evidence inside a moving system. The first market effects can still be positive. Fixed-rate bond prices generally move opposite market interest rates. When yields fall, existing bonds with higher coupons become more valuable. Lower discount rates can also help long-duration stocks. These are companies whose expected profits sit further in the future. Reducing the rate used to value those distant cash flows can lift their present value. Rate-sensitive sectors can respond too. Housing, utilities, and highly financed businesses may receive relief. That is why markets sometimes rally around cuts. The size of that benefit depends upon timing and duration. A bond does not rise merely because the word cut appears in a headline. Investors compare its fixed payments against the entire expected path of future rates. A small cut already reflected in prices can produce little surprise. An unexpected path of sustained easing can matter considerably more. The same idea applies to stocks. Markets price tomorrow before the policy meeting arrives. If everyone already expects easier policy, the announcement itself adds little new information. The explanation surrounding that announcement can matter more. But this is only the first ripple. Stocks are not interest rate certificates. They are claims on future business profits. Suppose a lower discount rate makes each future dollar more valuable. That helps valuation. Now, suppose expected future profits fall faster, sales weaken, margins compress, credit losses rise, hiring slows, the valuation benefit can lose. This is the second-order effect. The same cut supporting bond prices may also tell investors that policymakers see greater economic risk. Defensive assets can strengthen while cyclical companies lose earnings momentum. Cheaper financing helps most when a business still has profitable demand. It cannot turn an unwanted product into a wanted one. Balance sheets also change the outcome. A company refinancing debt soon can benefit quickly. A company holding long-term fixed debt may see little immediate change. Banks can face their own mismatch between asset yields, deposit costs, and credit losses. That is why one policy move can divide the market. Rate-sensitive assets respond through valuation. Cyclical assets respond through demand. Financial companies respond through margins and credit quality. Each channel follows a different clock. The market therefore faces two competing forces. One force lowers the cost of money. The other force lowers expected cash flows. The winning force determines the outcome. Instead of asking whether cuts are bullish, ask three better questions. First, why is policy changing? Look for language about normalization, balanced risks, or confidence that inflation is returning toward target. That supports the preventive case. Language about rapid employment deterioration, severe financial stress, or emergency facilities supports the rescue case. Second, what are earnings doing? If profit expectations remain stable while rates fall, cheaper money can improve valuations. If analysts are cutting revenue and earnings estimates faster, policy relief may arrive too slowly. Third, what is credit doing? Watch whether lending conditions, default expectations, and financing spreads improve. A policy cut matters less when lenders remain unwilling to extend credit. These signals will never provide certainty. They separate the mechanism from the slogan. Current context matters. The Federal Reserve's July 2026 report said policy had remained steady during early 2026. It also described solid economic activity alongside elevated uncertainty. That is not a recession declaration. It is a reminder that policy decisions depend upon changing evidence. If future cuts arrive, their meaning will depend upon the surrounding data. A cut after cooling inflation and stable earnings differs from a cut after layoffs, widening credit stress, and collapsing demand. The direction can match. The cause can be completely different. There is an important reason investors celebrate cuts. Preventive policy can work. The Federal Reserve does not need to wait for a recession. If inflation is controlled and policy is unnecessarily restrictive, gradual cuts can reduce pressure while expansion continues. The 2024 recalibration is a useful example of that logic. This is the soft landing argument. Policy can reduce restraint before weakness becomes self-reinforcing. Lower financing pressure can support housing, investment, and hiring without signaling that the economy already contracted. Markets can also fall before cuts begin, then recover while rates continue downward. The first cut never determines the entire cycle. New inflation, employment, credit, and earnings data keep changing the probability of each outcome. Therefore, saying rate cuts always predict a crash would be just as misleading as saying they always guarantee a rally. The signal is conditional. Rate cuts support markets when easing financial pressure matters more than weakening profits. They disappoint when the economic damage overwhelms the financing benefit. This story earns a capital ripple score of 84. Magnitude scores 34 out of 40. Policy rates affect mortgages, business financing, bonds, and equity valuations. Reach scores 27 out of 30. The transmission touches households, companies, banks, and governments. Persistence scores 23 out of 30. Rate changes can influence economic decisions for years, although policy can reverse. The score is high because the mechanism reaches almost every portfolio. It is not a forecast. When the next cut arrives, ignore the instant slogan. Do not ask whether lower rates are good. Ask why rates are falling. Check earnings. Check credit. Then decide which force is moving faster. Cheaper money can support asset prices. It cannot erase economic damage already inside future profits. That is the rate cut trap. Macro Moves Money explains the economic story behind your portfolio. Educational content only. Nothing here constitutes personalized financial advice.